Hello and welcome to Ftse Funds and Finance, the straight talking financial podcast brought to you by Goodwin Financial Services. I'm joined again by financial advisor Steve Goodwin, financial advisor Josh Goodwin. Gentlemen, how are we?
All good, thank you. All good.
Good, thank you.
So we're going to kick straight off with two things we're going to talk about today. We're going to talk about the economic news that's come out literally 10 minutes before we come out on air today, and we're going to talk about the mentality to invest in. Let's start with the economic news. Obviously, Money Facts just come up on, obviously, they're saying now the average 2-year fixed rate mortgage is approaching 6%. We touched on it briefly last week about the mortgage rates, etc. What impact do you think that's going to have?
Humongous. Yeah. It's just because when I've had it personally. You'd be quoting clients at the beginning of the year who are looking to start buying it this summer for whatever reason didn't quite get round to it. But in January, February, you're quoting probably to about 2.5%, and now between 5 and 6%. That's a big jump. And literally, I've had two clients turn around to me and say, "Well, I can't afford to buy. I'm going to have to buy half the price effectively." So I think that's going to be a huge impact. I think house prices should start feeling the impact very soon. Especially our area, I follow it quite closely. We've seen a lot of properties being reduced. I haven't seen the nationwide statistics, but I imagine that's going to start following soon.
And it's not it's not just new buyers it's going to affect as well. This is people with mortgage terms coming to an end. It's going to be felt by everybody.
I mean, although let's be real, they're doing average rates rather than the best rates, and the best rates are around about 4.8 on 2 year, down to 4.04% over 5 years, and the first time buyers get a slightly better rate. So it's bad, but not as bad as the headline. But that's always the same. Headlines make it look worse. But there is no doubt there are major problems. The nationwide house price index for September showed level, but I think this is going to be a delayed drip feed into the market. There is no doubt that pressure now is going to become downwards. It's just whether the market falters a little bit or it really slides. And history tells you that it takes momentum to make it slide, and it's whether this will carry through. If the rates do not come down much, you are going to see when a lot of deals finish, people have problems. I mean, I've been advocating, as you know, and Josh knows, for the last few years, that you've got to have a damn good reason not to do 5-year fixed rate mortgages. And whereas my understanding was around 75% of all mortgages through mortgage brokers were arranged over 2 years, and we know why that's done. But you had to have a good.
Why is that done?
Because they get paid again. So a mortgage broker, if they rebroker a mortgage every 2 years, gets paid again. So by them putting a client on 2-year deal, 2-year deal, 2-year deal, it means they get paid. So if you're doing a 5-year term, the mortgage broker or the financial advisor, who may also be a mortgage broker, only gets the chance of getting repaid in 5 years. But if you imagine that you do it 2 years, they get 3 chances of getting paid in 4 years. And that, whilst I'm not saying that's every reason, somebody doing a 2-year mortgage, say, over the last 2 years, the only reasons to do it is if they were fairly sure they were going to sell and not buy again, or there was some real reason that they didn't want redemption penalties for 5 years, they felt the relationship was in trouble or something like that. But there had to be a damn good reason. And if there wasn't a damn good reason, those people are going to be looking and thinking, oh my God, I might have deals here at 1.5% or 1.7%, and I'm coming off now at 5%. There's going to be issues, there's going to be some unhappy people, there's going to be people that can't afford to pay, there's going to be some repossessions. I don't know how bad the repossession market will get, but it does look as if that is becoming inevitable.
That's what they said in the thing today. And Josh, I mean, they're saying they could see significant scales of that of repossessions. And again, like Steve says, is that what you predicted potentially could happen?
Yeah, I don't see. It's kind of hard not to see that happening. I think there's definitely an argument for people to, up to a year before their mortgage come to an end, look at what the current rates are, and if they can't afford what the rates are going to be, they have to start looking to sell and try and avoid that situation at that point.
Could they do that before that, a year out? I mean, should the advice now be, whether you're 3, 1, 5, just get your head around?
I definitely think it's worth a night, especially people that are fixed up to 5 years ago. Could be on the 1.5%, 2% top rate, could be going on to 5s. That's a humongous difference. And there's no harm in looking as far out as possible to see what you potentially could be paying.
The secret is to get good advice, right?
Yeah.
Now, this is going to sound snobbish, but this is how I believe it. If you're going to get advice and your advisor is mortgage only, and that's all they can do, make sure they are part of a firm who've got general financial advisors as well, because that way you can get advice not only on mortgages but on somebody who is qualified within the firm to help and give advice on the actual financial aspects of it. Because mortgage brokers, they can't give financial advice, they just place deals.
Sure.
So there's a difference. If you get a holistic financial advisor who has got all qualifications, both mortgages and the financial planning, then that's okay. But if you're going to an estate agent where all they have is a mortgage advisor, then maybe that is not the place to go at a time like this.
So obviously that's going to worry some people. We obviously don't know where it's going to end up, the mortgage rates. We talked last week that we thought it could be coming up to around about this percentage. But so yeah, the advice is obviously try and get your advice, get your head around the mortgage market and your current mortgage at the moment. We're going to talk a little bit today about the mentality of investing. A different subject, probably one that's not talked about a lot on a financial podcast, and particularly the mentality to investing during a volatile market, which obviously we've seen over the recent months. I just wanted to talk to both of you about obviously the clients that you speak to and attitude to risk and that sort of thing, about why that's important. And the point I want to try and talk to you about is this long-term mindset. So I don't know if you could talk to us a little bit about that, Steve, about why it's so important to make sure that when you're investing, you're psychologically ready to invest in as well as financially.
So the first thing you do before you invest a client's money is you explain cycles. So the first thing is, I would say, on average historically, over a 5-year cycle, you have 3 up years, 1 level year and 1 down year. So the 3 up years, everybody's happy, aren't they? The 1 level year, people can sort of okay that, but it's the down year that matters. So you have to try and grasp a client's attitude to risk, but only that, the capacity for loss. The capacity for loss is how much will they accept that it goes down before they start panicking, moaning, whinging, whatever you want to say, or anxiety. So we go through that. And we go through that in great detail with clients about their risk, because a lot of clients think it only goes one way and it doesn't. In the short term. So we really go through that in great detail with clients. It doesn't mean that some clients who answer questions, they feel, I can cope with that, But then when the reality comes, they maybe can't cope with that. And that is the key, because if a client then starts to struggle to cope with it when it's on the downside, then they have to reflect, one, whether they should be investing, and whether they've got the mentality and capability to do it, and number 2, whether they are in the right risk category. We are absolutely fixated on making sure a client is in the right attitude, risk and capacity for loss. But you still get clients, the odd client, not many with us, that still can wobble. But generally, fortunately, because we really try and educate our clients as well as anything else, we don't really get that as a problem. Yes, clients are disappointed when markets fall, which is natural, but our clients seem to understand what they signed up for. They understand that's what it is, and they understand over the long term, and our clients have been with us for many, many years, have made a lot of money, and yes, and they've experienced these downturns before. So, but it is, a lot of people out there don't invest in the right risk category for the amount of risks they're prepared to take.
And part of it is because obviously you get a daily you get a daily market price, don't you? And I think that unnerves some people, because obviously today you can see it's up, 2%. Tomorrow it can be down 3%. It's that daily thing. I use the example as of the house buying. You don't get your house valued every week, right? Because you don't really mind if you're happy in your house and you've bought your house. You don't have to go and get it valued every week to try and do it. So it's so when you come to an attitude to risk, Josh, and when you're talking to somebody and stuff like that, how do you explain that to them? How is that, how it drops? How would you explain that to attitude to risk to people when making sure they're placed in the right place?
So within the attitude to risk questionnaire, there are some questions regarding if an investment failed by different amounts. So that's one way we gauge it. And two is just being open and honest. You talk about the most recent crash, big crash was the COVID crash. What happened during those crazy few months then. And then you say to people, this is what can happen. But over the long term, you look at any point in history, take the best day to the worst day, whatever way you want to look at it. Over a long period of time, it will go up and make money. That's what you've got to try and get clients to understand.
We just say caveat though, providing you're in the right funds.
I'll
just add that in because I don't want people to think they're in some of these dog funds that they're going to make money, and that's not true. You need to be in the right asset classes and right funds. So sorry, carry on.
Yeah. So and again for that. So in terms of that, so then let's talk about that. How do you find the right funds? How do you and when you talk about the attitude to risk and capital to loss with people, how are you explaining, how their money drops, how's it presented?
You go through in a sort of scenario. This is what on this risk level you can expect there being a risk to lose in a normal downside period, and there is you go through those numbers. But but a lot of clients will say, I get it's a long term, because if you look at something historically as well, we do our risk categories on 1 to 10. Historically, just forget 9 and 10, which are quite substantially high, although they still make money. But just take the risk levels. Forget 1 and 2. 3 is really low risk. But if you take our 4 to 8. What happens long term? 8 does better than 7. 7 does better than 6. 6 does better than 5, and 5 does better than 4. The more risk a client takes, the more reward there is long term. So there is no doubt about that. No doubt that will continue over the next 20, 25 years. Mm-hmm. There is no doubt. The more risk you take, the more reward you get. But the problem with, say, risk level 8 is you will suffer much bigger downturns when the market falls. Mm-hmm. So not everybody is suited to 8. So some people will be suited to 6. Mm-hmm. And also the other thing is, if somebody, while they're accumulating, in other words, while you are building investments and investing, you can take more risk and more capacity loss than when you're withdrawing. So somebody coming to retire may have been risk level 7, 8 in their time. They may want to drop to 5 or 6 because they want to consolidate what they've done. They accept they're going to get less growth, but they don't want so much on the downside. Mm-hmm. So at different points in their life, different clients should be in different risk levels. That's why your financial advisor, who does regular reviews and assesses it for you, is so important, because you can change not only the risk level, mm-hmm. but look at the funds, which are crucial mm-hmm. on an annual basis. Because choosing a fund is all about understanding who is the fund manager, what their track record is in the past, whether you believe that the style of investing is going to work going forward. Not short term, but you're looking on a 5-year view, and making sure that the fund manager just doesn't leave. Because mm-hmm. if the fund manager leaves, the fact it's the same fund doesn't necessarily mean that that the past performance is relevant. So you track the manager himself.
That's important, because I know it's a thing you've used before. It's a bit like a chef in a restaurant, isn't it?
Yes.
The chef might be great. But if the chef leaves, it's still the same restaurant for the quality of food. And
exactly, that's what I use with clients.
And it's important to make, from what you were saying there as well, about obviously regular reviews attitude to risk, because people's attitude to risk can change literally year by year, can't it? It's literally different situations, whether they've been married, whether they got older, job situations, that can change, can't it, throughout the life cycle of a client?
Yeah, definitely. I'd say generally with younger clients, it goes up the longer they do it. So the few I've had over the last year, they start off with maybe level 6 or 7. They come the next year for their annual review. We do the risk questionnaire again to make sure they're happy with everything. And usually they come out 1 to 2 levels higher, which was my experience. I think sometimes you speak to older clients who are in retirement or close to retirement, start thinking, I don't think I can stomach a big drop in my funds anymore. And sometimes you see them go the other way. But it depends on personal circumstances. But yes, throughout an investor's journey, their attitude to risk does change. And
that's where the annual reviews become so important, because obviously a year is a long time, isn't it? A lot can happen in the markets and in someone's life in a year.
But what's been unique in the last year is being low risk hasn't protected you.
Sure.
Because the way that fund managers have protected clients' money is by the use of bonds, gilts and fixed interest assets. Well, because of the inflation, they have fallen in some cases worse than equity markets. Mm-hmm. So you need to sort of look at a client and sometimes you can say, well, if you're in risk level 6 because of that style of investing, that could really be slightly lower risk than a risk level 4 fund. And this is something we've had lots of chats with clients about recently. And clients have moved up in risk because they want the different style of fund, because they don't want it all reliant on bonds and gilts to protect them. So it's whatever it is, whoever's investing, you need regular reviews, you need regular understanding, and you need to trust. You need to trust and feel comfortable with your financial advisor, because if you don't trust them and feel totally comfortable with them, this journey is not for them, because you've got to understand that when things are tough, that you believe in your advisor, you believe that your advisor knows what he's doing, you believe he's doing the right things, and you have total faith in them. And that's crucial.
And you're placing the attitude to risk. And as you say, investing is not for everybody, and there's no problem with that, and there's no problem if people can't, everyone's different. It's no problem if someone can't psychologically handle those dips, but getting them placed in the right attitude to risk is important.
100%.
And Josh, coming back to what you said before about the COVID crash, it's interesting. I just wanted to talk about the 5 biggest market crashes in the US markets, and we'll talk about the US markets. Although we're UK based, the US economy has a much bigger thing on the world economy. So I talked about that, and the reason I want to talk about this is in a way to reassure people that crashes happen and cycles happen, and it's.
What I do want to say though is too many clients, and even my clients, they forget and they get fixated about the Ftse in the UK market. 70% of the Ftse 100's income is derived overseas. So it's what's really going on abroad. The UK market and the fact that Liz Truss is doing this and that is nonsense. I saw a tweet this morning, right, from John Redwood, who was an MP. So I know I'm sidetracking it, but I've got to mention this. I thought this was... John Redwood said, Liz Truss should be commended. Her U-turn has meant that the stock market, Ftse, has recovered, and blah, blah, blah. It's the biggest load of nonsense. The market has recovered this week so far because of US data that is showing that they think that the American banks will not need to be so aggressive with interest rates. That has filtered through to China, Japan, and the UK. But he's trying to claim it's Liz Truss. It's just nonsense. We are such a small, insignificant part of the world market. If the American market sneezes, we have a cough. It's just how it works. Just how it works.
Yeah. So again, talking about that US markets, obviously we'll talk about the crashes. Obviously, the one you mentioned, the last big one we had was obviously the 2020 COVID crash. I've just got some figures here. I want you guys to talk about it. Obviously, some of them are obvious, but then so in that instance, the global markets lost about 34%, and the time it took to recover was 33 days.
But do you know what happened? The 34% was like really fast.
Yeah.
And everybody panicked.
Dropped off a cliff, literally.
That was a bigger fall than what we've received.
Yeah.
People don't realise that the COVID fall was bigger than this year, but it recovered, they didn't realise. But this year it's a bit deeper. What then happened was it fell, and then we were all in lockdown, and this is what people don't realise. So we're all in lockdown, nobody can really work, everything's looking desperately bad. Rishi Sunak introduces the furlough scheme, reassures the markets that people trusted Rishi Sunak, right? The market boomed back up. So while we're in recession and people aren't working, the market's booming. Why? Because they look ahead of the game. But it recovered fast because Rishi Sunak took appropriate measures, reassured the markets, and the markets boomed. It was like a really short V.
Yeah, literally 33 days.
It's very small because it was an overreaction. Sunak sorted it. This is in the UK, and went up. And the same thing in America. They did it in America. Every country absorbs the same thing. They put money into the economy. They introduced quantitative easing. They flooded the markets, both in the UK and in America and around the world. And the markets boomed back up again and boomed ahead. I mean, 2020, people don't realise. You get clients go, yeah, we had a bad year in 2020. So you didn't, you all made money. 2020 was a good year. Yet, at one point, it fell 33%. I had one client panicked. No, actually, I'm lying. 2 clients panicked. And they either one encashed and lost a fortune. One reduced his risk, lost a fortune. And both clients are back in the market now, and they realise they made a terrible judgment.
That comes back to what we've done here, the one we always bang about in the office all the time. Time in the market, not timing the market.
Exactly.
So in it for long term. That's one thing we always bang about, investing for the long term. And obviously, Josh, the 2021 you mentioned, that's obviously one you remember in your career. Going back a bit before that, you'd have remembered this, Steve. You'd have experienced it. 2008, we had the subprime mortgage crisis. The S&P in particular lost 57%. Obviously, we know that was very bad. The time to recover took about 17 months. I don't know if you want to talk about that. Well, hence the mortgage crisis is coming.
And the Ftse fell 48%, right? I remember doing it. I think 48%. Now, compared to today is nothing compared to that. That was horrific. That was the biggest. I mean, I had two things I remember: the 2000, the dot-com bubble, and this one. That was hard because people were seeing. I remember pacing around here in my house and talking to people time after time, trying to reassure them, and it all came right again. And people that were in that remember it. But that was severe, and it makes. And today, where you're seeing falls in risk level 7 and 8 of about 20% over a year, give or take, at the moment. Well, you were seeing falls much bigger than that in 2008. But it's just part of what we go through. This fall now is not as bad as that. That was pretty desperate because now they were worried about banks around the world crashing and burning. And that's a lot more serious than what's happening today. Today is a recessionary setback around the world. That was a thing that the whole infrastructure looked under threat, and that was very worrying. But I mean, what was the recovery? Was it a couple of years or?
No, wait, 17 months. Yeah, so 17 months to recover.
But 17 years. But people saw falls of nearly 50%, and in 17 months afterwards, it was back again.
Yeah.
So really, as long as you do not panic and get yourself and you can cope with it, it came back.
And that's why I wanted to talk about this as well. I know it sounds shocking when you hear some of these figures we're going to come on to, but the key I want to talk about is investing in markets. They go in cycles. You get dips, you get peaks and troughs. That is the point, and it's just to try and reassure people. Obviously, you mentioned before 2000, the dot-com bubble. We've all heard about that, even if we hadn't done it. Obviously, the Nasdaq, which is slightly different, but the Nasdaq lost 77%, and that took 15 years to recover. But that was only Nasdaq. I know that.
So let's look at what was going on. So at that, whilst the Nasdaq is now a much more, I would class as a stable index, because people accept that that people like Apple, and these are much more.
And it's tech stock, Nasdaq, if they don't know, basically.
But going back into the year 2000, and going the years before, people were setting up these technology companies because technology was a big thing, and it was in sort of its infancy, and they were setting up companies that were worthless. And they were being valued at these massive amounts. So I've compared that to like what was happening with crypto. It wasn't a stable market, but people latched on and went into these technology funds, and people lost everything. They were remortgaging their houses to do it. But that's what they were doing with crypto last year, right? And crypto's done about 60-70% in the last year.
Yeah,
so what's happened with crypto now is very similar to what happened with Nasdaq then. But Nasdaq is now a refined index, and although you don't buy the index, you use companies on the Nasdaq. But my God, that was horrific. But those people, the greedy ones, that went into Nasdaq towards the end, I mean, they lost everything.
And the Nasdaq took a while to recover. Obviously, it was 15 years, but the global markets obviously see a bit of that, didn't they? But obviously, they recovered quicker than the 15 years, didn't they?
And that's why you wouldn't invest somebody in one specific area, and that's where I have a problem with crypto, is that you're investing in one specific area that's not regulated. It's the Wild West, right?
Yeah.
And to be honest, the Nasdaq in the late 1990s was the Wild West of investing.
And then obviously going back before mine and Josh's time, probably in your time.
That's before my time.
Is it?
2000, I was only 5 years old.
But you were still here.
I can barely speak at that age.
But you'd have heard of the dot-com bubble, but I'm sure you'd have heard of these.
While I was pushing this pram, I was having to deal with these clients that were panicking about their investments.
They only come out these pram 3 weeks ago. So it's right. The 1973, the oil crisis and economic recession. The market lost 48%. Took 21 months to recover. Don't know much about it. Don't know if you can touch on.
Yeah, I mean they were going back in '73. It was before my time, but obviously when I've studied the markets, it was again a very similar sort of thing to what we're going through now, but you also had you didn't have the financial financial well-being things that you have today. I mean, if you imagine the UK in the mid-70s, it was just chaos. The markets were in a bad place. I think if I'm right in saying, the UK market fell something like 50% in 1 year in the mid-70s, and then 30% the year after. It was pretty bad. That was a pretty bad fall. It was probably the worst that we've had in living times. But you had in the UK, you had rubbish on the streets. You had a Labour government that was. It was probably the worst government that, whatever your political views, probably the worst government.
I think this government's giving them a run for their money.
This government's pretty bad. So I'm not saying from a perspective, but they were pretty bad, and that's when Thatcher came in and swept to power because it was so bad. I mean, Callaghan and all everything, they were bad. So the whole thing were there, and the infrastructure that exists now around the world markets, it's more stable now. So I don't expect to see things like the 73.
And a lot of these infrastructure talked about come because of these markets, isn't it? Coming to help
to try and hold it down.
And then just one from obviously the worst crash in history back in 1929. So even before your time, the Dow was down 89%, and it took 25 years to recover. That was the start of the Great Depression. But again, the reason I wanted to touch on this was just to remind people that, you know, these things happen. And have you got any closing advice we bring up? I think we talked to Tim.
What I say to everybody is this, and you can't help it. When you give clients reports when things are boomed, some get too excited.
Sure.
And then they want to pile more in investments. I had clients when we've had really good years want to remortgage their houses to do things at a time when the market is high. And you don't want to get too elated when it's up, and you don't want to get too depressed when it's down. And I would also say that it's exactly that. It's timing. It's time in the market. Because if you stay in the market and you get good advice, then in the long term, you're going to make more money in that asset class than you will in any other asset class, probably apart from property. Gold is a stable commodities and everything else, but in the long term, it's a proven asset class. So as long as you use it as part of your portfolio, don't put too much in it. Make sure that you have a balanced portfolio and you get right advice.
It's also right diversification within your investments, isn't it?
Exactly, and that as well.
That's really key. We haven't really touched on that today, but
it's true.
When you see something that falls in the Nasdaq and stuff like that, that's why you sometimes want to diversify around the world, whether it be UK, Asia, Europe. That's another reason why you want professional advice.
The old don't put your eggs in one basket.
Specifically, I would say not necessarily geographically, because a lot of Josh is right that you can have, for example, China at the moment, which is a little bit, it's going to do different things than the rest of the world. But a lot of countries now are intermingled in their trading. But it's very specifically to the types, as we said, growth stocks, tech stocks, really, really good long-term performers. But you don't want it all in there.
Sure.
That's exactly what Josh is saying. And you might want funds that have some commodities in there, some oil, and blah, 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 where they will, or companies where they are doing different things.
And I know it's something I bang on about, but that's why you have a financial advisor. That's why you have a decent strategy in place, so you don't go too big when you get excited, and you don't go too the things. So that's the roundup. So obviously, if I hope this has helped, and I'll put some of your minds at rest with the mortgage things, and hopefully help some of those with the mentality investing. And thank you very much, gentlemen, and we'll see you again next week.